You're fired.
You're firing me?
Long time coming.
It's about the future of Axe Capital, making it what it's supposed to be. Unassailable, untouchable, unbreakable. An institution that's TBTFW, too big to with.
In this video, we're breaking down the high-stakes finance lessons from Billions Season 3, Episode 8, based on my work experience at Goldman Sachs and while I worked at the top hedge funds in the world. Now, please like, comment, and subscribe, and stick around because at the end of this video, I'm going to grade the episode for Wall Street realism with a buy, hold, or sell rating. Now, in this episode, billionaire hedge fund manager Bobby Axe Axelrod returns to Axe Capital after a legal battle, and he immediately shocks his team with a scorched earth strategy. Dump every investment they're holding and start fresh.
Clear the board. Unwind all current positions. We will rebuild a new book. All new positions will be run through me.
Axe is basically telling his traders, sell everything, even profitable bets, and begin anew under his direct oversight. Now, in finance, unwinding positions means closing out, meaning selling longs or covering shorts that the fund has a position in. And a book is just trader lingo for the portfolio of investments. Now, Axe wants a clean slate so he can recalibrate the fund strategy from scratch. Now, why would a hedge fund manager do this? Well, often it's about risk control and strategy reset. Axe has been sidelined by legal troubles and now he's back in charge. And by cleaning up the board, he wipes away positions chosen by others and ensures that he calls the shots on every new trade. It's kind of like a chess player resetting the board to execute a fresh game plan. And in real life, this might happen when a new manager takes over a fund or after a crisis. They shed legacy investments to realign their vision and risk appetite. The downside? As Axe's teams protest in this episode, is they're giving up some winning positions. And that leads us to our next lesson, because Axe is not stopping at a clean slate. After wiping the slate, Axe reveals an aggressive growth plan, raise a massive amount of new investor money. But his twist is psychological. He wants to position Axe Capital as the prize.
We're doing a massive cap raise and quickly. 20 bill within 6 months, but we position ourselves as the buyer. We make them beg us to take their money.
Now, here, a cap raise means raising capital, basically getting more cash from investors to manage. And Axe wants to collect $20 billion in 6 months, which is a massive sum. But note the power move. Position ourselves as the buyer. Now, what he's doing here is he's flipping the script. Instead of Axe Cap seeming really desperate for investor cash, he'll act like investors are the ones who need his firm. In other words, make them beg to get in. And this is a real phenomenon with elite funds. Top-performing hedge funds often create exclusivity, and they might cap their fund size or selectively accept money, which makes institutions really eager to invest. And investors will tolerate high fees or lockups if they believe the returns will be amazing. For example, some legendary hedge funds have delivered such stellar performance that clients are willing to pay the hefty fees of 2 and 20 or much more just for access. And it's kind of like a hot concert everybody wants tickets to. Demand outstrips supply. Now, Axe is counting on Axe Capital's recent success, now that he's beaten the legal case, to create FOMO, meaning fear of missing out, among investors. Now, in real life, a hedge fund called Renaissance Technologies had an incredible average return of more than 70% between 1994 and 2015. And during this period, the worst performance in 1 year was up 21%. And because of this, instead of charging a 20% performance fee, Renaissance charged over 40%. Now for Axe, by making investors feel privileged to be allowed in, a fund can raise money on its own terms. And it's a really savvy strategy. When investors chase you instead of you chasing them, you can charge premium fees and pick only the money that best fits your needs. And the lesson is this: when you have a winning hand, use that leverage. And success breeds investor interest, and the best funds turn that into an advantage, raising capital on their terms. And just remember, as an investor, don't be blinded by exclusivity. Always judge the investment on its merits, not just its swagger. And one intense scene here involves Todd Krakow, a hedge fund rival turned US Treasury Secretary who secretly approaches Axe with a political tip. And Todd has insider knowledge about an upcoming government decision that could make millions.
The EPA is about to rescind a certain regulation that will prop up the entire natural gas space.
Now, in plain English, Todd is saying the Environmental Protection Agency is going to remove a regulation, and once they do that, the whole natural gas industry will benefit and stocks will shoot up. And it's very normal for investors to get really excited whenever a new government official is elected who might deregulate an industry, like we've seen recently, potentially in the financial services index, which is why financials have outperformed in the past couple years or so. Now, this Todd Krakow issue here is material non-public information, a government insider tip. And if Axe trades on this before the public, that's classic insider trading, of course, which is illegal. And Axe knows this, of course. Now, the financial concept here is how regulatory changes can massively impact stock prices. And environmental rules often pose costs on industries. And if a strict rule is lifted, companies like natural gas producers could earn higher profits and their stock prices might surge. And traders who know about such policy changes ahead of time can profit big time. But trading on non-public inside information from a government official is illegal for good reasons. Obviously, please don't do it. Now, it really undermines fair markets, and the SEC defines illegal insider trading as buying or selling a security while in possession of material non-public info, especially when it's obtained through a breach of duty or trust. And yes, this includes tips from government employees. Regulators have nailed people for exactly this kind of thing. So the lesson learned is this. Policy events move markets, but you must trade on them legally. And professional investors do keep an eye on policy announcements, regulatory filings, and press releases. That's fair game. For example, if there's a public proposal to relax EPA rules, anybody can speculate on natural gas stocks, and quite often they do. But what Todd is doing, giving Axe a secret heads up, really crosses the line. And it's an example of the temptation in high finance to seek an edge via connections. And the show highlights this risk. Axe is fresh out of legal trouble and extremely wary of stepping into another trap. But in reality, insider trading can lead to hefty fines and many years of jail time. And the ethical takeaway is this: don't play with insider information, please. Instead, investors can legally monitor policy trends, for example, election results or new laws, and invest accordingly, but always with publicly available information. Next up, let's talk about Taylor Mason, Axe's brilliant young CIO, meaning Chief Investment Officer. Now, Taylor has been running things very successfully in Axe's absence, and Taylor is not thrilled with Axe's new autocratic approach. And in one scene right here, Axe tries to reward Taylor with a fancy sports car for good performance, but Taylor has a different ask: real autonomy.
Forget the car. I want my own book. $1 billion to manage unencumbered. You took your ball back. Give me something of my own.
And we know that book means a chunk of the fund's capital, which Taylor alone would control. And Taylor is saying, skip the Lamborghini, stake me with $1 billion of the firm's money that I can invest my way with no interference. And the concept here is autonomy for star performers. And in finance firms, whether it's hedge funds, mutual funds, or trading desks, top talent often negotiates for independence and a slice of capital to manage. It's like a company within a company. Why? Because rock star investors want to prove themselves and not be second guessed on every single move. And for the firm, it's a way to motivate and retain talent. And if you don't empower your rising stars, they might leave to start their own fund. Taylor asking for $1 billion to run is essentially, give me my own portfolio to prove what I can do. And this teaches us a few things: skin in the game and trust. Axe has to trust Taylor with a large sum. Trust is huge in finance terms. Now, a good boss recognizes when to hand over the reins, or in this case, a portion of the reins, to keep top employees engaged. And Taylor really earned this ask by outperforming the market while Axe was away. Here we have autonomy versus control. There's a balance between centralized control, which is Axe's instinct, and decentralized decision-making. Too much control and you stifle innovation in all companies. Too little and you risk chaos. Now, Axe initially balks, but then agrees. He grants the $1 billion book plus the car to Taylor. He knows keeping Taylor happy is worth it. Taylor is a money maker. And for viewers not running hedge funds, think of this lesson in simpler terms. If you have somebody in your team with great skill and a track record, sometimes the best move is to give them room to run. And in personal finance, it's like when you gain experience. You might carve out a portion of your savings to invest in your own style, while perhaps keeping the rest in a more managed strategy with lower risk. And autonomy can lead to innovation and performance as long as there's accountability for results, of course. Now, one of the episode's most memorable moments is when Axe unceremoniously fires Spyros, who is the firm's compliance officer. And Spyros is an obnoxious stickler who hasn't exactly been popular at Axe. And Axe and his CEO, Wags, frame the firing in a colorful way by discussing who qualifies as a Wilbury. This is a reference to the Traveling Wilburys, which is a legendary rock supergroup.
Legends only need apply.
And you, Spyros, it has become clear, are not a Wilbury.
But I am.
You're fired.
Now, that's harsh, but Axe basically tells Spyros, you're no legend, you're out. That's how we say it in Canada. You're out, I'm Canadian. And the Wilbury talk is a metaphor, of course. Axe only wants all-star players on his team. And a Wilbury in their code means somebody with an ineffable mix of skill, cool, and credibility who adds huge value. Spyros doesn't cut it. And the financial workplace lesson here is about adding value beyond just doing your job. And Axe even spells it out by saying this next.
You might have done your job, but you have failed to provide additional value. And you have ostracized the entire company.
Well, I'll prove it to you. I do have value. I am a Wilbury. Well, I am all the Wilburys put together.
So Spyros did his basic compliance duties, but he alienated colleagues and didn't contribute to profits or cultures. Now, in a lot of hedge funds, if you're not a producer, meaning analyst or portfolio manager, or a trader with a book, you're not as respected. It is what it is. And in a high-performing hedge fund or any competitive field, just meeting expectations is not enough to secure your spot at the table. You need to bring something extra. And top firms foster a legendary-only culture, for better or for worse. And it can be brutal, as we see. Spyros gets a tongue lashing and a pink slip in one go. Now, from a career perspective, the takeaway is this. Strive to be indispensable. In finance, that means generating investment ideas, fostering client relationships, or having specialized expertise, something that goes beyond your job title. And if you're merely just there, you risk being shown the door when the boss decides to clear the ranks. Spyros had also ostracized himself. He was universally disliked, which meant when Axe looked to trim fat, Spyros had no allies. Now, on the flip side, this scene also shows how sudden finance firings can be. 1 minute you're at the desk, the next minute security is escorting you out. And it underscores the performance-driven nature of hedge funds. And it might seem harsh, but Axe is resetting his firm with only the people he considers A players. And as Spyros is being booted out, he suddenly dangles intel that stops Dollar Bill Stern, who's a seasoned trader at AxeCap, in his tracks. And Spyros' information is about a list of companies under secret SEC investigation. This sets up a trading strategy using that info.
I can still access a list of all the public companies being investigated by the SEC, but have not disclosed the investigation. You can short the companies that you think will go down when the investigations come to light.
And go long on those that get dinged by the bad press from being looked into and shoot up when they're ultimately cleared.
So this is a classic event-driven strategy, profiting from news of regulatory investigations. And let's break this down. So Spyros has a list of companies under the SEC investigation that the public doesn't know anything about yet. And perhaps from his prior work, recall he used to be at the SEC. It's like he kept a confidential cheat sheet. And some of those probes will turn into serious fraud or misconduct, meaning they have teeth. And when those eventually become public or lead to charges, the stock price of that company will likely plunge because investors hate uncertainty and potential fraud. Other investigations will end up being nothing. And those companies' stock might dip on initial news of an inquiry, but when they're cleared of the wrongdoing from the SEC, the stock will bounce back up. The plan here is to short the likely bad actors and go long the likely innocents. And shorting means selling a stock you borrowed, hoping that the price falls so you can buy it back cheaper for a profit. And it's essentially betting on a price drop, in this case, betting that once a hidden SEC investigation comes to light, the company's stock will drop like a rock. And going long is the normal way of investing, meaning buying stocks to hold, expecting the price to rise over time. And Bill would buy shares of companies he suspects will be cleared, because initially their stock might be undervalued due to rumor or minor bad press releases, but once cleared, the stock prices should shoot up big time. And a real-world note, companies under SEC investigation often see their stock drop when it becomes public. Here's an example. When news broke that Under Armour was under SEC investigation, the stock fell 19% in just one day. And many firms never disclose investigations unless something major is found. So insiders with that knowledge have an unfair trading edge, which in reality again raises legality issues. And the educational takeaway is this: understanding short selling and event-driven moves. And short sellers often research and identify companies likely hiding bad news or engaging in fraud. And if they're right, when the bad news emerges, the stock falls and they profit, of course. Conversely, value investors sometimes look for stocks beaten down by temporary scares, meaning if a company is wrongfully suspected of trouble and its price drops. And that's a buying opportunity if you believe it will recover in the long run. Now, I have a course that will potentially help you find accounting issues with companies so you can potentially short them. And here's what you do. You type in the name of the company, select your AI prompt level here, and then you answer many questions using AI to analyze the income statement, the balance sheet, the cash flow statement, and most importantly, the footnotes from the 10K, meaning the annual report. Then you can print out a one-page write-up or a 24-page detailed report. And you can bring this to interviews too. And for more details, set up a Zoom call with me. The link is in the description. Now let's shift gears from trading back to basics. Let's talk about fees. A fiery scene here occurs when Axe's estranged wife, Laura, storms into the office, upset that her money in Axe's fund is being charged full fees. And this gets confrontational and educational at the same time. Let's check out the confrontation.
This 2 and 20 fee charge has got to be some sort of clerical error, Bobby.
No error. You can move your money if you want, but if you want me to manage it, this is the cost. Didn't you read the agreement?
So Laura expected a free ride for her money, but Axe is treating her like any other client now, partly out of spite, given their divorce battle. And she specifically mentions 2 and 20. And this term is crucial in finance. It refers to the typical hedge fund fee structure of a 2% management fee and a 20% performance fee. The 2% management fee is charged on the total assets invested, regardless of performance. And it's basically an annual fee for managing the money, meaning paying the staff, keeping the lights on, etc. For example, if Laura invests $100 million with Axe, a 2% yearly fee means $2 million, which goes to the firm no matter what. Now, the 20% performance fee, also called an incentive fee or carry, means the fund takes 20% of any profits made for the client above some threshold. So if Laura's portion of the fund earned $10 million in profit last year, Axe's firm would keep $2 million of that as a performance fee. If there's no profit, generally the 20% is not taken. And this 2 and 20 model is standard for hedge funds and also venture capital and private equity funds. And it heavily rewards the manager for good performance, which investors tolerate if returns are really high. But it also ensures the manager makes money even in flat years, meaning from the 2% fee. And critics say it's hefty, it's true. And imagine paying somebody 2% per year plus giving them a fifth of your gains. But elite funds justify it by aiming for outsized returns that net investors a lot even after fees. And investors really have to understand the fee structure of any fund they invest in. Are there performance hurdles as well, meaning minimum return before performance fee kicks in? Is it 2 and 20? Are there high watermarks? These details really matter for your net returns. And for most casual investors, hedge fund fees are steep, which is why many stick to ETFs or mutual funds with lower fees. But really, really wealthy investors often accept 2 and 20, hoping the manager's skill will deliver far above market returns, which justifies the cost. And in recent years, there's pressure on fees. Many funds now charge a bit less, like 1.5 and 15, or even 1 and 10 for friends and family. Speaking of which, following that heated argument, Axe and Laura negotiated a deal that intertwines fees with a lockup period. And a lockup means investors agree not to withdraw their money for a certain amount of time. And what Axe does is he offers Laura a fee discount if she consents to a long-term lockup and symbolically agrees not to move their kids away. Let's check out the negotiation highlight here.
I'm ready to give you a discount on the fees if you sign an agreement, a 7-year lockup. 1.5 and 15, and one more thing. The boys, they're not going anywhere till college.
For 1 and 10.
Deal.
There's a lot packed in there. Axe is basically saying, I'll lower your fees, but in exchange, your money and our children must stay put for 7 years. And he offers to cut fees from 2% management and 20% performance fee down to 1.5 and 15%. And Laura pushes for an extra sweeter deal, 1% and 10%, and Axe agrees. And that's a huge reduction. That fee structure is extremely investor-friendly, usually reserved for founding investors or families. Now, why would Axe concede that? Because the 7-year lockup is hugely in his favor. Now, the lockup period is a period during which an investor cannot withdraw their funds from the hedge fund. And in the fall of 2008, when hedge funds were in big trouble, this lockup concept really saved the bigger hedge funds from going belly up. And by locking in Laura's money for 7 years, Axe ensures stability. He can invest long-term without worrying that she'll pull out cash at a bad time. And larger and more successful hedge funds often use lockups, commonly 1 to 3 years for new investors and sometimes much longer. And they do this to prevent sudden redemptions that could force them to sell positions at the wrong time. And a 7-year lockup is very, very long, practically private equity length. Axe is essentially tying not just Laura's capital, but also her to New York since she can't move the kids for those years. And in return, she gets a break on fees that could save her millions of dollars. Now, the concept here is a liquidity trade-off. If you give up liquidity, meaning the ability to take your money out, managers are often willing to charge you less fees. Why? Well, locked-in funds allow management to plan longer term for investments, especially in illiquid assets, without fear or outflows. And it's very valuable to them as well. So they'll incentivize you with lower fees or better terms. And in real life, big institutions might negotiate lower fees by agreeing to be an anchor investor or to commit funds for a longer period. And it's all negotiable for sizable accounts. Now, from an investor viewpoint, accepting a lockup means you must trust the manager and not need that money for quite a long time. And Laura presumably won't touch that chunk of wealth for 7 years, which is fine given the fact that she's insanely rich. But for many, a long lockup is risky. What if the fund underperforms for many years and you're stuck? And that's why some hedge funds have hard lockups, meaning no withdrawals at all, versus soft lockups, meaning you can withdraw early, but you pay a penalty. Always understand those terms, please. And for us, the lesson is twofold. Number one, understand fund terms. If you ever invest in alternative assets, know the fees and lockup. And they vary and can often be negotiated if you bring them a large investment. Remember, closed mouths don't get fed, always ask. Number two, liquidity has a price. If you give up access to your money, demands something in return, like lower fees or higher target returns. Conversely, if you need liquidity, expect to pay a little bit more or get slightly lower returns. And it's a fundamental trade-off in finance. Now for our final lesson, let's pivot to a broader insight, not about trades or fees, but about knowing what game you truly want to play. And this comes from a conversation between Wendy Rhodes, who is both Axe's performance coach and the wife of U.S. Attorney Chuck Rhodes. Now, after Chuck is pressured by political kingmakers to run for governor and compromises himself, Wendy drops a gem of wisdom right here.
You don't want to be in politics. You want to be beyond politics.
Now, this line is not about stocks or hedge funds directly, but it resonates with the financial world's theme of autonomy versus hierarchy. Wendy tells Chuck essentially, you thrive when you answer to nobody. In your current job, you're like a king. And if you run for office, you'll be a puppet. And that's not who you are. Now, in the show, Chuck realizes he's happiest wielding power independently as a prosecutor, rather than climbing to a higher title that actually comes with more strings attached. And the lesson here is this. Know where you have freedom and control and value it. Now, please cover your ears as I'm about to cuss. Sorry. You don't want to spend the rest of your life being someone else's bitch. Always start side hustles and turn them into your full-time gig. Otherwise, something terrible is going to happen to you. You're going to wake up one day and you're going to have problems getting out of bed because you don't want to go to work that day, as the jerk you work for pays you this much money to make their own dreams become a reality. Let me help you write a business plan. See the link in the description and set up a Zoom call with me. Now, in a career or financial context, sometimes the shiny promotion or bigger title, or more money even, is not worth the trade-off if it means losing your autonomy. Live free or die. For example, a star investor might choose to run their own fund with more freedom, albeit more risk, rather than take a prestigious job at a big bank where they're constrained by bureaucracy and they feel like a freaking government official. Now, an entrepreneur might prefer being their own boss rather than selling their company or working under a conglomerate, even if the latter is more lucrative on paper. Recently I had an investment bank approach me to buy my company. I thought about it. It was tempting, but I'd work for somebody else. I don't want that. But Chuck is beyond politics. And this is akin to saying he'd rather set the rules rather than live by others' rules. And in finance, many hedge fund managers feel this way. They left banks or institutions to have the freedom to invest their own way, without committees or higher ups. And it's an important reminder that true power often means independence. Now, we know that money is one form of power, but the show often contrasts two types. Axe's raw financial power versus Chuck's government authority. So well written. And Wendy highlights that Axe, and by extension Chuck when he's at his best, operate beyond the normal structures. They make their own game. And for us, the takeaway can be personal. When making a career or financial move, consider more than just the immediate reward. Think long term. Consider your autonomy, happiness, and principles. And a job with a fancy title, or running for office in Chuck's case, might come with compromises that makes you really unhappy. You'll be happiest on day one, then it goes downhill from there, eh? And sometimes staying in your lane, where you call the shots, can lead to greater success and satisfaction. And Wendy, being a performance coach, recognizes that Chuck is truly alive when he's free to act on his own terms, not when he's appeasing donors or party bosses. In short, beyond politics equals play the bigger game. Now, in investing, it might mean don't get caught in a short-term status contest, like beating a benchmark every quarter, if it sacrifices a long-term strategy you know is right. And in life, it means value your true independence. And it's a fitting final lesson from Billions. Finance is not just about numbers, it's about power, freedom, and knowing what truly drives you. Now let's talk about grading of this episode for Wall Street Realism with a buy, hold, or sell rating. The episode did a great job of highlighting how many people in the hedge fund industry are libertarian and independent thinkers that want full autonomy and freedom. The episode also did a great job of articulating the concept of hedge fund fees, lockups, and much, much more. But the episode was unrealistic in that you wouldn't see the head of the Treasury conspire with a well-known corrupt money manager to make money. Also, the episode unrealistically shows Axe thinking he can raise $20 billion in 6 months, especially given the public scrutiny on his unethical business practices. As a result, I'm going to give this episode a hold rating. Please like, comment, and subscribe, and I will see you soon in my next reaction video, which is Billions Season 3, Episode 9. Thank you.